All right, let's dive right into this explainer with a completely counterintuitive premise. We've all been raised to believe that success means being the absolute best, right? Coming in first, winning at all costs. But what if I told you that winning in the incredibly high-stakes world of financial markets actually means being the best loser? Today we're exploring the brilliant insights of a trader named Tom Hougaard. And just to give you a quick idea of the level this guy operates on, while your average trader might risk, say, $10 a point, Tom is actively risking an astonishing $3,500 per point, literally. So how on earth does someone manage that kind of pressure without completely losing their mind?
Well, it's important to understand that Tom Hougaard isn't just some guy who got lucky one day. His insights come from deep, deep experience in the trenches. He was a former London broker who spent a decade on the trading floor, and during that time, he had a front-row seat to watch 100,000 clients make nearly 100 million trades. That's a mountain of data, and what he realized from analyzing all of it is absolutely fascinating. Lasting success in the markets? It isn't about having the fanciest technical charts or the most expensive top-secret software. It is entirely 100% about mindset.
And that brings us to this staggering number, 95%. That is the devastating failure rate of retail trading. Now pause and just really think about that for a second. If market movement is largely random, effectively a 50-50 bet most of the time, how is it statistically possible for 95% of people to consistently lose a coin toss?
Let's get into Section 1, the inconvenient truth, and exactly why the 95% fail. This brilliantly illustrates the sheer difficulty of the game we're talking about. Getting into Harvard University is universally recognized as one of the hardest academic feats in the entire world, right? It has an acceptance rate of just 4.5%. Well, the success rate for traders is right around the exact same mark, about 5%. When you see it laid out like this, it proves beyond a shadow of a doubt that the failure isn't because of a specific bad broker or some rigged system. No, it is a systemic, human failure.
Which brings us perfectly to the core thesis of our explainer today. In trading, unlike life, it's the best loser that wins. This goes against literally all of our modern biological and societal conditioning. Success in this arena is absolutely not about being right all the time. It's about mastering the art of losing.
Moving on to Section 2, blame the reptile mind, our biological saboteur.
Okay, back in the 1960s, neuroscientist Paul MacLean identified that the human brain evolved with a highly primitive area called the reptile mind. Now, your logical neocortex, the sensible voice in your head right now, thinks it's in charge, but actually it's not. When perceived danger approaches, your subconscious reptile mind completely hijacks your decision-making to protect you, triggering an intense fight-or-flight response. And let me tell you, losing money triggers this biological survival alarm bell extremely loudly.
Consider this crazy neurobiological fact. Humans feel a financial loss 250% more intensely than a financial gain. And the wildest part, the loss doesn't even have to be real. It could just be a paper loss on a screen, and your brain still short-circuits as if you're being chased by a predator. This massive intensity spike of pain causes incredibly intelligent people to act completely impulsively, abandoning all logic just to make the pain stop.
Section 3. The Gladiator Mindset. Let's talk about rewiring the brain.
Think of the movie Gladiator for a second. Before stepping into the deadly arena, Maximus rubs dirt on his hands. It's this physical ritual to leave his old self behind, to essentially immunize himself against fear so he can survive the battle. Well, Tom Hougaard has his own version of this. Every single morning, rather than looking at complex, flashing trading charts, he opens a simple PowerPoint presentation filled with his old mistakes, triumphs, and warnings. It's his daily ritual to kill his normal human ego and become the emotionless trader that the market demands.
And the core mental cue he uses to do this is a rhythmic mantra. He tells himself to flip the switch. When your reptile brain is absolutely screaming at you to run away from the pain of a trade, you have to flip the switch. You have to stop running away from the pain and actually start running toward the danger, exactly like the top 5% of elite traders do.
This takes us to Section 4, 3 commands for success, the 5% blueprint.
Tom learned a specific roadmap from a legendary master trader in the extremely intense Chicago Mercantile Exchange pits. Step 1, assume you are wrong. Step 2, expect to be uncomfortable. And Step 3, add when subtracting. This is the exact blueprint for how the elite 5% operate completely differently from everyone else. So let's break these down, shall we?
Command 1 is assume you are wrong. Look, the 95% enter a trade assuming they are right. So the second they see a tiny little profit, their brain panics, terrified the market is going to take it away. They snatch that profit early just to feel safe, heavily capping their wins. The 5%, on the other hand, assume they're wrong from the very start. When they go into profit, they don't celebrate. They literally expect the psychological discomfort, they accept the pain of uncertainty, and they just stay in the trade.
And that brings up the crucial point of Command 2, which completely shatters the oldest cliché in trading. Normal traders love to say you can't go broke taking a profit. The 5% say you absolutely can go broke taking a profit. Think about it. If you constantly take tiny little profits to soothe your anxiety, but you let your big losses run, you will destroy your account. The 5% don't shrink their winning positions. They actively add to them, aggressively pressing their advantage when the market actually proves them right. And that leads to Command 3, which tackles something called the supermarket effect. If a brand new TV goes on sale for 25% off at the store, hey, it's a bargain, so you buy it. The 95% treat financial markets the exact same way. When a stock falls, they think it's cheap, so they buy more of a losing position. But the 5% know the market has zero memory. Supply and demand dictate price. Just because it fell doesn't mean it's cheap, so the top traders cut their losses immediately.
All right, Section 5, the 5 roadblocks, the mental minefield.
Even with those commands, you have to fight 5 internal emotional roadblocks: fear, hope, guilt, confidence, and market logic. These will totally hijack your brain. Take fear, for example. Tom shares this incredible story of being at a pool when his young son accidentally fell into the deep end. Before the lifeguard or any of the other adults even registered what happened, Tom instinctively leaped over the sun loungers, fully clothed in a suit, and pulled his son out. He recognized the fear and reacted instantly to neutralize it. In trading, you must react to a losing trade with that exact same instant mechanical speed. The second roadblock is hope, and honestly, it's destructive. The 95% sit around and hope that their small losses will eventually turn back into winners, and that leads to massive account destruction. The 5% do the exact opposite. They fear that their small losses will become big losses, so they just ruthlessly eliminate them right away.
Then there's guilt, which brings up a really thought-provoking question. Why do we always feel the need to be doing something? We're heavily programmed by the Protestant work ethic to be super productive. So when the market opens, traders feel guilty if they aren't actively pushing buttons and making moves. But here's the thing. The market doesn't pay you by the hour. Sometimes, the absolute most profitable move is sitting on your hands and doing absolutely nothing.
The final 2 roadblocks are confidence and market logic. Tom once had a massive 100,000-pound profit day just by aggressively shorting the market. But he warns that overconfidence right after a big win is absolutely fatal because you stop expecting the pain. And as for market logic, just forget it. The market is completely illogical. I mean, on Christmas Eve in 2018, the Dow plummeted 800 points for virtually no reason at all, and then 2 days later staged its biggest one-day rally ever. If you expect the market to be logical, you're going to go broke. When we zoom out and analyze over 43 million trades, the data tells the ultimate story. A high win rate guarantees you absolutely nothing if your bad trades wipe you out completely. Financial success isn't some final destination. It requires a continuous, never-ending process of neutralizing your own personal flaws day after day after day. You have to master your mindset if you ever want to master the market.
Which leaves us with one final, provocative question for you to chew on. Are you ready to flip the switch and become the best loser? Remember, the secret to all this isn't hiding in some magical software program or a complex technical chart. It is found in your internal acceptance of pain. Stop running from the discomfort, start leaning into it, and master your own mind. Because ultimately, that is how you win. Thanks so much for joining me on this explainer, and I'll see you next time.